Investors, hello. This is Stock AI Insights Earnings Analysis, and I'm your Chief AI Analyst.
Today, we're parsing NVIDIA's massive third-quarter fiscal year 2026 earnings, which cover the quarter that ended on October 26, 2025. Now, just a quick reminder, this is all for educational reference only and not investment advice. All right, let's jump right in. I want you to just look at this number for a second. $57 billion. That is what NVIDIA pulled in as revenue in a single quarter. It's a number that's so big, it's kind of hard to wrap your head around, and it really sets the stage for this incredible story of growth and the massive challenges that come with it.
So here's how we're going to unpack all of this. We'll kick things off with the big picture numbers, then we'll dive into the data center, the absolute engine behind this whole thing. After that, we'll get into the details of their profitability and margins, navigate some of the global headwinds they're facing, look at the gigantic bets they're making, and then wrap it all up with our final verdict.
Okay, so first things first, let's look at that top-line performance that has everybody talking. This table tells such a fascinating story. You see revenue exploding by 62% year over year. I mean, that's just wild. Net income, their actual profit, is up even more, a stunning 65%. But here's the interesting part. Take a look at the gross margin. At 73.4%, it's still incredibly healthy, right? But it's actually down a little bit from last year. And that small dip, that's our first clue that things are a lot more complex under the surface of all this growth. We're definitely coming back to that.
Let's keep building on that. So where is all this record-smashing revenue actually coming from? Well, the answer is pretty simple, and it's really all about one thing: the data center.
Look at this chart. Honestly, the bars say everything you need to know. Data center revenue didn't just grow, it went into orbit. From just under $31 billion to over $51 billion in 1 year. It's not just a division anymore. For all intents and purposes, it is the company now.
And to really put that into perspective, this chart shows how dominant it is. The compute and networking segment, which is basically all data center, accounts for nearly $51 billion of that $57 billion total. And graphics, the business that NVIDIA was famous for, it's now just a tiny sliver of the whole pie. What a transformation.
You could say their data center revenue isn't just a single rocket ship. It feels more like an entire fleet of them launching all at once. The company says this is all thanks to the incredible adoption of their new Blackwell architecture, which they say is already making up the majority of their data center revenue. Just an amazing ramp-up. And NVIDIA themselves actually tell us why this is happening. In their 10Q filing, they say it's all driven by 3 platform shifts. Basically, the whole world is shifting to accelerated computing, there's a crazy demand for powerful AI models, and we're seeing the rise of what they call agentic applications. So, in simple terms, the world is fundamentally rebuilding its digital infrastructure for AI, and NVIDIA is selling all the essential gear.
But growing this fast is not easy, and it certainly isn't cheap. It creates a ton of pressure. So let's go back to that gross margin question we flagged earlier and really dig into the costs that come with scaling at this pace.
So why did that margin dip even just a little? Well, the filing tells us it's a direct result of their incredible success. They're moving from selling components, like the super powerful Hopper systems, to selling entire, full-scale Blackwell data center solutions. Think about it. They're selling bigger, more complex, and way more expensive integrated systems now. And while the total profit dollars are going through the roof, selling the whole shebang naturally puts a little pressure on the percentage margins.
And there's another little detail in here: inventory provisions. All this means is they're setting aside some money because of the risk that older products might lose value, which is totally normal when you're transitioning from one blockbuster product like Hopper to the next one, Blackwell. The 0.1% impact is tiny, for sure, but it's a perfect little financial footprint that shows the cost of innovating so relentlessly. Okay, let's zoom out a bit. NVIDIA's success doesn't just happen in a bubble, and that brings us to some pretty significant headwinds they're dealing with on the world stage.
So the biggest and most direct challenge is geopolitical. The company is very blunt in its filing. U.S. government rules that require a license to export their H2O product to China have significantly hit demand and revenue from that region. This isn't some theoretical risk, it's happening right now. And look at this chart. It really lays out these risks in black and white. On the left, you have customer concentration. Just 4 customers, 4, make up 61% of their total revenue. That is a huge dependency. And on the right, you see the geographic hit. Revenue from China dropped from $8.1 billion down to $3 billion in just 1 year. That's what it looks like when global politics directly impacts the bottom line.
This quote from their own risk factors section really nails the tightrope they're walking on. They talk about long manufacturing lead times and uncertain supply. At its core, the problem is trying to line up this incredibly complex global supply chain with demand that is both huge and highly concentrated. It's a very, very delicate balancing act.
So you might think with all these risks, they might pull back a little, right? Nope. They're doing the exact opposite. They are making absolutely monumental financial bets to secure their position for years to come.
The scale of these numbers is just breathtaking. They've committed over $50 billion to lock down future manufacturing and supply. They have another $26 billion in multi-year deals for cloud services. On top of that, they've committed up to $10 billion for a strategic investment in the AI company Anthropic. This is a company that is using its massive profits to build a fortress around its business.
And this really gets to the core question, doesn't it? For NVIDIA's leadership, for investors, for everyone watching, how do you manage tens of billions of dollars in long-term commitments when your day-to-day business is so exposed to global politics and supply chain chaos?
All right, so we've looked at the mind-blowing growth, the hidden costs, the external risks, and the enormous bets on the future. What's the final takeaway from this quarter?
Here's our verdict, all in one sentence. NVIDIA's results show a juggernaut of growth fueled by its dominant data center business, but it walks a precarious tightrope of geopolitical restrictions, supply chain complexity, and massive future commitments.
So the key things to keep an eye on are pretty clear. The data center is, without a doubt, the engine. Their amazing margins are still strong, but they're going to keep feeling the pressure from their own success and changing business model. And those geopolitical and customer concentration issues? Those are the top risks to watch. And finally, this is a company that is being incredibly aggressive, using its cash to lock in its future. What are your thoughts? Let us know in the comments. We'll see you for the next analysis.